When saving for retirement, most people will have access to 3 different types of retirement accounts: 401k, Roth IRA, and a traditional IRA. So in this video, I'm going to simply explain the difference between these types of accounts and how they are taxed. At the end of the video, I'll talk about another account that isn't necessarily a retirement account, but is a great option if you want to retire early. But first, let's cover the 401k account. Just for our basic understanding, all of these different accounts are just different vehicles that hold your investments. Most of the time, you can hold the same stocks that are in your 401k in your IRAs as well. So if you buy $100 worth of the S&P 500 index fund in your 401k account, the difference between buying $100 worth in an IRA is how you are taxed and the penalties you are charged for withdrawing. Things like that, but no difference in terms of the actual stock holdings or returns. So most companies will offer a 401k account to their employees to help them save for retirement. This account plan allows the employee to contribute a portion of their wages to the account tax deferred, which just means they do not have to pay income taxes on the money that they put into the account at the time. For example, if you made $100,000 for the year and you put $10,000 into your 401k account, you would only pay $90,000 in income taxes. This $10,000 is not put in all at once. You are having your employer deduct a certain amount each paycheck to go towards this account. But you are still deciding how this money gets invested. Your employer will give you a few different options of what types of stocks, bonds, or money market accounts you want to deposit your money into, using a brokerage account like Fidelity or Vanguard. Oftentimes, your employer will match your contributions to a certain amount. For example, a lot of employers do a 3% match, meaning if you decide you want 3% or less of your earnings to go in your 401k account, they will put the same amount of money that you did into the account, giving you a 100% return on your investment. It's fine to do above 3% of your earnings, but your employer will still only contribute 3%. There are a few contribution limits to the 401k. In 2024, the limit for how much the employee can contribute is $23,000 for ages 50 and younger and $30,000 for ages 50 and up. The employee and the employer contributions together can be no more than $69,000 a year or $76,500 if they are 50 and up and doing catch-up contributions. Catch-up just means if they didn't meet the contribution limit in a previous year, that they can deposit a little bit more to make up for it. But unless you become disabled or go through some other type of extreme financial hardship, there is a 10% penalty on top of the ordinary tax owed for withdrawing any money from the account early. Once you turn 59 and a half, you will have full access to your 401k and you will be taxed at the ordinary income tax bracket you fall in. Because remember, you didn't have to pay taxes on the money you originally put in. If you are not in need of the money in retirement, you will be required to start taking minimum distributions at age 73. So as a summary, the pros of the 401k are: you lower your taxable income, no income limitation, high contribution limit, and many employers offer 100% return match. The cons of a 401k are limited investment options, withdrawals are taxed at ordinary rates, and taxes will most likely go up in the future or you'll be part of a higher tax bracket, and limited access until age 59. So the traditional IRA is much worse than the Roth IRA and is actually more similar to the 401k than the Roth IRA. IRA stands for individual retirement account and is not connected to an employer. You can open an IRA through any online brokerage account like Fidelity and have access to any stocks, bonds, or money market account that Fidelity brokers, giving you a lot more options than the 401k. The traditional IRA is the same as the 401k, with it allowing you to contribute pre-tax income, lowering your taxable income and deferring your contributions taxes until retirement withdrawals. If you make over $240,000 in income, you can still contribute to a traditional IRA, but you cannot defer the taxes, defeating the main purpose of the IRA. The other big difference is no matter what your income is, you can only contribute a maximum of $7,000 each year into a traditional IRA. Unless you're over 50, then you can put a maximum of $8,000 into your account. If you withdraw from an IRA before 59 and a half, you will face the same 10% penalty and ordinary tax owed. But an IRA is less strict than a 401k with its exemptions to this 10% penalty. You will not face a penalty for withdrawing from an IRA if you have to pay for medical expenses, qualified educational expenses, up to $10,000 for a first-time home purchase, and up to $5,000 for a childbirth or adoption. It also contains the same mandatory withdrawals as the 401k, starting at 73. So as a summary, the pros of the IRA are lower your taxable income, wide investment selection, and many exemptions for withdrawing money early. The cons are low contribution limit, limited by income amount, paying ordinary income tax for withdrawals, and limited access until age 59 and a half. Now the retirement account with the most insane benefits is the Roth IRA. The Roth IRA is accessed the same way as a traditional IRA through an online brokerage account. But instead of deferring taxes until retirement, you put money into the account that you have already paid income taxes on. And so you don't have to pay any taxes for retirement withdrawals at all. And that means all your investment growth is tax-free. So it is the opposite of the 401k and traditional IRA. For example, if you started with $7,000 and you put $200 a month on money you already paid income taxes on into a Roth IRA, after 40 years you would have $1.4 million and only contributed $96,000. The other 1.3 is all from your investment's growth over time. So you already pay taxes on the $96,000 worth of contributions, so it makes sense that you don't have to pay taxes on this again, but you never pay taxes on the $1.3 million worth of interest. The IRS allows you to withdraw all of this tax-free because it all originated from the money that you already paid taxes on at first. With the 401k and traditional IRA, you don't pay taxes in the beginning. You have to pay taxes on your withdrawals, which includes all of your investment growth over the years. And the investment growth is most likely a lot more money than your contributions were. That's why the Roth IRA is so much better. But that doesn't come without some extra requirements. The Roth IRA contribution limits are the same as the traditional IRAs, with a maximum of $7,000 per year if you're under 50 and $8,000 per year if you're over 50. But the Roth has stricter income limits than the traditional. If you are filing single and your modified adjusted gross income is over $161,000, then you cannot contribute to a Roth IRA. If you are filing married and your income is over $240,000, then you cannot contribute to an IRA as well. Your modified adjusted gross income is just your overall gross income, so what you made before taxes were taken out, minus a few small deductions that the IRS allows. The Roth IRA is also unique when it comes to withdrawals because it allows you to withdraw your contributions tax and penalty free at any time, just not your investment interest until age 59 and a half. So if we look back at the example, if at the end of your first year of contributing, you need $8,200, you can take this out penalty and tax free, as long as you don't withdraw the interest of $750. So if at the end of this 40 years, you're still not 59 and a half, you can withdraw all your contributions of $96,000 because you already paid taxes on it. And you will still have $1.3 million in your account growing for you. So when you turn 59 and a half, the interest on your investments will be penalty and tax free. You will have full access to it as well. Also, Roth IRAs have no mandatory withdrawals required. So as a summary, the pros of the Roth IRA are tax-free investment growth, full access to contributions made, tax-free withdrawals, wide investment selection, and no required minimum distributions. The cons are income requirements and low contribution limit. Another account not many people take advantage of is the standard taxable account. So this is not considered a retirement account, but if you're part of the FIRE movement and want to retire before age 59 and a half, this account and real estate investing is your best option. A taxable account is opened individually through an online brokerage account, and a lot of people think taxable accounts are taxed twice on the same money. But it is not. It is just not tax advantaged like the retirement accounts are. You put money into a taxable account with after-tax income, just like the Roth IRA, but once you sell, your investment growth is taxed. So you don't pay tax again on your contributions when you withdraw them because you already did, only the investment interest once it's withdrawn. This type of account is very beneficial for people who want to retire before 59 and a half because there is no penalty to withdraw any money from a taxable account at any age. If you leave your money invested for at least 1 year, you will pay long-term capital gains tax. Here's the bracket for that, which will usually be at a lower rate than if you sell before 1 year. In that case, your investment interest will count towards your regular taxable income. Here's that tax bracket. So as a summary, the only really con is it's not a tax advantaged account, and the pros of the taxable account are wide investment selection, no income or contribution limits, and penalty-free withdrawals at any age. With the taxable account being so liquid, it's a great account to save for big life purchases like a wedding or car. And I actually made a video on how you can use a taxable account to save for a down payment on a home. You can watch that video here, and if you need help buying, selling, or investing in real estate, my information will be in the description.